Welcome to Dollars and Cents. Our podcast is designed to provide listeners with financial advice in a language you can understand. Created and hosted by Marc Freedman, President and CEO at Freedman Financial, he discusses timely topics that help individuals and families make smart financial decisions. Count on lots of energy, candid discussion, and a few laughs. And now, here's your host of Dollars and Cents, Marc Freedman of Freedman Financial.
Welcome back to another edition of Dollars and Cents. I'm here as your host today, Marion Gilman. My typical co-host, Marc Freedman, is not here today, so I am delighted to have Christian Karcher co-hosting with me. Christian is our Director of Financial Planning at Freedman Financial, and since April is National Literacy Month, we really wanted to start off by looking at literacy and starting off as those young people just graduating from college, getting their first jobs. We wanted to take a look at that and what does financial literacy mean to them and how can they get started on their journey towards saving towards their future goals, whatever those might be. And Christian, who better to have here? Christian is an expert in this area of financial planning. So we're delighted to have him here with us today. How are you today, Christian?
I'm doing well. How are you, Marion?
Very good, thank you. So Christian, you started your journey maybe more years than you think right now, right? You're almost 8 years out of school?
I think so. I've started to lose count of them.
So
I feel like I feel like that tells me that it's been a little bit of time.
Absolutely.
I'm starting to lose track. But yes, I think 8 years is correct.
Right. So why don't we talk a little bit about, the importance of financial literacy and getting started young on trying to achieve financial goals. What would you tell somebody graduating from college as a new graduate?
Absolutely.
Getting their first job.
Yeah, absolutely. As you're starting out on your journey for finances and financial literacy, it's really important to kind of catch yourself up to speed on quite a few things. Obviously, there are positive things you can do, saving for retirement, but there's also avoiding a lot of the traps that hit people young who might not have that background in financial literacy. Things like building up credit card debt, or not truly understanding their own student loan payments, or buying a house or renting a place where it's way too much of your income and makes it so that you can't save. So avoiding those pitfalls and setting yourself on a trajectory where you can start making positive decisions that will compound and grow and help you later on.
So there are a lot of things to think about.
Absolutely.
And one of the reasons I think Financial Literacy Month came into play is that many young people have no idea what to even think about as they start their first job. All of a sudden, they're getting this paycheck. It's a fairly substantial paycheck. And, they look at it and say, oh my goodness, what do I do now? I might have some benefits at work. Should I sign up for those benefits? What should I do with all this money? And, we want people to certainly go and enjoy after they've worked hard through college and they're now getting their first job and working hard as well. On the other hand, you have to think about the future, right?
Absolutely. And so what you often see and run into is this kind of paralysis by analysis. You get these huge stacks of paper and you go, I don't even know where to start. And so
those employee benefit packages, right?
Oh, absolutely. And you're flipping through and you get through the first, you say, I'm going to really read it. It's kind of like when you're in college and they send you the syllabus and you see all the required readings and you say, oh, I'll start doing that. And you get 10 pages in and go, I'm done. The same thing happens with the employee benefit book. And so the question becomes, what steps can I take? And oftentimes people go, I start reading it, I start thinking about it, and then I don't do anything. So the most important thing is to take that first step and that next step and just taking it one step at a time. And one of the great things that a lot of companies have done in recent years is kind of grease the wheels there and help people take those next steps.
Absolutely. So what has happened over the past maybe 10 years is companies have realized that individuals it takes them a while to actually sign up for a retirement savings plan, like a 401k. So they're offering, the companies are offering very good ways to save for retirement. They might even match what your contributions are. And it's a great way to set money aside. But a lot of individuals weren't taking advantage of it. And part of that was education. They just didn't know what it is. I mean, what's a 401k? And unless they had somebody that they trusted that they could ask, they might not have even thought about signing up for this thing that they were going to put money into. So many companies have now implemented a plan where automatically a certain percentage of your salary, and it's usually like 2 or 3%, nothing onerous, but that goes automatically into the 401k and gets invested. So this avoids you having to do something, and that's helpful. But the other thing they might run into as not knowing the 401k, another interesting benefit would be disability insurance.
Absolutely.
Do you think 22-year-olds know what disability insurance is or means?
Well, certainly not. And there's a lot of different types of disability insurance. But realistically, it's a little bit less variable from employer to employer.
Right.
Very often what you'll see is you'll have a base disability benefit of 60% of your income. So if you are permanent or long-term disability, so if you have a disability where you are out of work for a long period of time, months or years, what this disability payment would be about 60% of your salary, which
And
is
they give you that money, and you can't work if you can't work.
if you can't work, which is great. But also, as you're, beginning to spend and you've got rent and you're buying food and you might want to go out, buy gifts, talk to people,
Yeah.
Be out in the world. If you become disabled, would 60% of your income actually get you to that point where you could spend comfortably? For some people, yes. For other people, no. So that's something you've got to think about is this 60% enough? Oftentimes they'll offer you additional coverage up to 70%. That's starting to get a little bit closer. And then you start thinking about, okay, do I have other money that I've set aside over the years that can help fill any gap if there was a long-term disability? But
Right.
particularly for young people where you have a long career ahead of you, the biggest risk to your financial situation at that point is a long-term disability. It's not the markets going up or down. It's not, your own income, getting fired from your job, because realistically, you've got a lot of years to find another job.
That's right.
It's a permanent or very long-term disability that's going to dramatically impact your income.
Right. So if you're, again, and you do typically take on a variety of payments, so you can't live without money once you start working. And certainly if you're married and children, so you want to be conscious of this. And very frequently, there are human resources people at the company that you can go and visit with, and they'll tell you all about the different benefits that are offered. And we would strongly urge everyone to take advantage of that. Of course, in our office, what we look at is we want you to be cognizant also of saving for not only retirement, but outside of what the company is offering, saving for your goals as well. And what's one of the first things we tell people in terms of saving? What should they do first if they have a little bit extra, a little more than what they're putting in their retirement plan and what they need to spend on their bills? What should they do with their money then?
Right. And this is the one that I talk to a lot of people who are coming right out of college and they go, really? This is kind of boring. But it's very important to put money aside and have 3 to 6 months of expenses in an emergency fund just sitting at the bank.
That's a lot of money to keep at the bank.
It is. But we just talked about long-term disability. We talked about potentially losing your job. We want to make sure that if one of those events happens, that you have cash to draw on to meet your expenses, so you're not adding up debt on credit cards where interest rates are very high. We're trying to avoid those negative actions so that we can at least remain neutral, so that we hopefully can make positive contributions to our future retirements. And step one for that is getting together an emergency fund. So many people in that first job who might have some amount of financial literacy say, I'm really excited to put money away for retirement. I want to invest some money in an investment account. And oftentimes we have to tell them, that's great. Let's start doing that by maybe 10% of your income, making sure you get the match on your 401k plan.
Right.
But the next step is let's get that emergency fund done. And once that is funded and available to you, and you've got that nice cushion, which, 3 to 6 months of expenses is a lot to save. It
Yes,
takes
it
a couple years to get up to that number.
Absolutely.
And so we kind of back people up, we get to that number, and now we can start looking at, okay, what other investments do you need to be thinking about? How much more do you want to contribute to your retirement accounts? Are you thinking about purchasing a home? What does that look like?
Exactly.
That's generally the cadence of people coming right out of school into a job. These are the things that are up top of mind.
And that's great. And a lot of people, coming out of school, top of mind is not retirement. So they think about it and they say, what can I start saving for retirement now? I want to buy a house. I want to buy a new car. I've got all these other goals. Why put any money in retirement? That's 40 years down the road. That's just crazy. And is that a good assumption to make, Christian?
It's not, but you hit on one of the important points of why it actually is important, and it's that it's 40 years down the road. One of the greatest benefits of saving and investing is the value of compounding interest over long periods of time.
And they always say it's not timing the market, it's time in the market.
That's absolutely right. So I just have a couple of fun numbers here that I like to talk over with people.
Great.
Around this age, and they say, what if I just start saving at 30 instead?
Yeah.
And so
why put money away at 20 for your retirement, right? I'll wait till 10 years.
Right. And when you actually do the math, if you're a math or a spreadsheet person, you can do this yourself. And you realize that the contributions, those first 5-10 years of a 40-year time period, are the most important and will see the largest amount of growth. So if you got on an investment account over a very long period of time, just 6%. I'm not talking, 10 or 15%, just 6%, which is a very conservative return assumption. And we said, okay, well, there might be some inflation too. So let's adjust down the inflation and say we are just returning 4% net of inflation on our investments. $1 invested at age 20, by the time you are 65, could grow to $5.80, called $6.
Okay.
So $1 becomes $6. That's a pretty good deal over a really long period of time.
Yeah.
If you wait until 30, that $1 only becomes $4.
Really?
So
that's big of a difference.
That big of a difference.
So, and it doesn't sound like a lot, maybe, to you when you think about, it's only $2, right? But multiply that by 100 or 200 or 1,000 or 100,000. That's a big number.
It is a huge difference. And so what we always say is when you're young, every dollar in is incredibly valuable. Make sure you're saving something. Even if some people say, I can't max out my retirement contribution, so maybe I just won't do it. That it should not be what you're thinking. You should be thinking, if I can just get one more dollar in, it'll be $6 down the line. If I can get $100 a month in, that'll be $600 down the line.
And that's just a one-time contribution. That's not counting if you're doing it every paycheck, which is 26 times a year.
Absolutely. And so that's why we encourage people to contribute when they're young. When you get older, when you're in your 55, a single dollar, you only have 10 years left before you're 65.
Yeah.
That's going to be maybe $1.50. So at that point in your life,
what you can do with that.
At that point in your life, it's not about how much you are putting in necessarily. It's about how much the money that you saved many years ago is compounding and growing.
Exactly. So you're making money on your money without saving any more at that point, which is great. So we encourage everybody to take advantage of that saving early, the ability to do so, and leaving it in their long term and let the market work for you. Well, I think that's going to do it for today, unfortunately. However, if you'd like more information from us, we have a weekly newsletter that comes out every Friday at 10:30 in the morning. You can go to our website, freedmanfinancial.com. That's Freedman.
Two E's and a D.
That's usually my line. .com. You go to any page on the website, scroll down, sign up for our weekly newsletter. And if now's a time for you to get serious about your money and you need some advice on, putting all of this together, you have questions about whether you're prepared for retirement, whether you're doing the things correctly, give us a call, 978-531-8108. That's 978-531-8108. We're here. We'd love to chat with you, and also take advantage of that newsletter because there's lots of good information in there. Thanks so much, Christian. This has been great.
Thanks for having me.
Hopefully, Financial Literacy Month, everybody goes out and looks at all the sources of information out there and takes advantage of saving for the long term. Bye-bye.
During today's Dollars and Cents episode with Freedman Financial, your hosts may have discussed specific financial planning and investment ideas that are for general information only and not intended to provide specific advice or recommendations. Please remember that investing involves risk and may include loss of principal. Although the money market fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund. Always consult a certified financial planner professional, qualified attorney, or tax advisor prior to investing to determine what is appropriate for you. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.